When we talk about African risk and we talk about currency risk, what exactly are we alluding to? Because we know that most African central banks are intervening quite extensively in their currencies and do try to keep things stable to try and avoid the volatility.
Yes. So typically when we look at exchange rates or any market, in fact, when we talk about risk, we talk about volatility. But in Africa, volatility is an inadequate measure of the risk inherent in the currencies. Because a lot of the currencies, as we spoke about last week, tend to see considerable sideways moves and then one-off large jumps. In other words, you've got sharp devaluations. Yeah. Normal volatility measures don't capture these risks. And of course, the big one is simply that you can't trade some of these African currencies. So you might have exposure, but you've got that liquidity risk, just simply not being able to get out of your position.
Is there appetite to trade some of these African currencies?
Sure. Obviously, from corporates as a start, importers, exporters, as in any market. So yes, definitely there is the appetite.
We're talking about the Central Bank of Kenya a little earlier, and they have been trying to increase their reserves and really intervening in the markets on a weekly basis. So the market is basically taking it as a signal of currency intervention. It has been stuck in a relatively interesting range for the most part of the year. What do you make of manipulation of currency? Is that a very big risk, or do you think it offers a little bit of security for investors out there?
Yes, well, every central bank within Africa intervenes in the currency market to some extent. I mean, it differs quite considerably. So South Africa, Zambia, for instance, are very rarely in the market. And you get down to the countries which attempt to peg the currencies, Nigeria, Angola, which are in the market constantly every single day. You're completely correct that intervention by the central bank should reduce volatility, and our guess is that it does. Nevertheless, when you look at the volatility of the African currencies, they still tend to be incredibly high. As we know, the rand is the most volatile currency in the world. Zambia, Mozambique, Botswana, all those currencies have substantial volatility. And even though some central banks try and peg the exchange rate, across Africa you get at least moderate to high volatility on the dollar cross.
Looking at the global events that play out on a day-to-day basis, we're talking about currency wars. How exactly does that impact currency volatility in Africa? Because it seems that we're relatively decoupled from the events that occur elsewhere.
Perhaps not as decoupled as you would think.
Apart from South Africa, I suppose. When you look at the likes of Kenya or Nigeria, the currency moves on a day-to-day basis, if you watch them closely, don't really respond to what we see on the dollar-euro crosses sometimes.
Yes, so it's not necessarily tracking euro-dollar, which is something that the dollar-rand would track very closely. But when we did our analysis, we were quite surprised to find that a lot of these currencies are in fact very tied in with international markets. So Kenya, Zambia, Botswana, all the liquid currencies in Africa, the relationship might not be as close to euro-dollar as it is in South Africa, but the link may become via commodity prices, global growth, etc. So, in fact, these currencies are generally quite strongly tied in with the global markets.
You mentioned commodity prices. We're talking about why African currencies are relatively volatile. What is the single biggest factor that make African currencies very volatile?
You find across countries, across the world, the poorer countries generally tend to have more currency volatility. And I think that's probably explainable by the fact that there's less liquidity in the market, less money coming through, less speculators there that can
Other measures to complement the currency
act as stabilizing influences in these markets. So as countries get richer, volatility should come down. Hopefully they move towards more free market floating exchange rates such as Zambia and South Africa. Yes, that generates a day-to-day volatility, but avoids that jump risk, that liquidity risk that we see in some of these other countries.
Just elaborate further on jump risk and exactly what you mean there.
So jump risk typically arise because you have a pegged exchange rate. Think of Nigeria and Angola. Before the crisis, they were pegged constantly against the dollar. Everything was fine. Oil prices came down substantially. They tried and unsuccessfully so tried to maintain that pegged exchange rate. Eventually, they had to give up, and you saw instantaneously overnight a 15% to 25% devaluation in the currency. So one day you're trading at one rate, you come in the next morning, you're 25% away from where you are. Very different from the normal type of currency risk that we're used to in a more first world setting. And along with jump risk, what you also tend to find is liquidity risk. So again, liquidity risk is just the inability to trade. So various of the very inefficient markets. Think of Malawi in particular in Africa, sometimes Mozambique, sometimes Nigeria. There's not the supply of dollars in the market. So you might want to get dollars, you might have the local currency, you phone up the bank, but the bank is simply unable to give you those dollars. They are constrained by the regulations. It can be a very troublesome situation, particularly for someone importing into those countries. You can't pay for imports, very disruptive to your business.
Let's take Zimbabwe as a very interesting example, given the fact that they embarked on extensive quantitative easing, or the printing of money, and this is why we saw their currency devaluing extensively over the last couple of years. They've now embarked on dollarization. What kind of risks can come to the fore when it comes to African currencies? Because I'm sure investors really look at some of the central bank strategies and, of course, the political scenarios that are playing out as well when it comes to investment or trading in these currencies.
Yes, so Zimbabwe is an extreme example. Monetary printing, hyperinflation, eventually the currency just depreciates away until no one is willing to use it anymore. But you see a similar situation, although certainly less extreme, in a lot of other African currencies. So the DRC, Malawi, for instance, where you have considerable growth in money supply as a result of inflation, and therefore the currency just tends to depreciate or devalue constantly. So some of these countries in Africa, the two I mentioned for instance, have never actually shown any appreciation against the dollar. There's no risk historically of ever appreciating. It's only a matter of how much is it going to depreciate. And that creates a certain risk environment that corporates have to manage. In a South African setting or international setting, you have to worry about two-way risk, volatility. The rand can strengthen and it can weaken. In some of these currencies, you only have to worry about the fact that it will weaken. They never ever have actually appreciated.
Well, that's quite an interesting point. Okay, looking at the corporate side of things, you mentioned the way that corporates have to deal with their business in those countries. Do you find that a lot of the corporates, in fact, prefer to deal with dollars and euros as opposed to embarking on ensuring that they also trade in local currency? Do you think that's a trend that has emerged?
Yes, certainly. You've got a large degree of dollarization in Africa. By that I mean that the dollar is the de facto currency used in these countries. So Zimbabwe is the obvious example. The Zimbabwean dollar no longer exists. They use the US dollar and the South African rand. But various other countries in Africa have some similar situations, even if their local currency still is in circulation. So you'll find a lot of the smaller countries in West Africa, for instance, might have this outside of the CFA zone.
Do you think it's a hindrance, or do you think it's a benefit for the country itself?
Well, it's a benefit. You need a currency to be a store of value so that you can transact. If you have no faith in the value of your currency, there's no point in having it. That's effectively was the problem in Zimbabwe. And you've got that not just in West Africa, but a huge degree of dollarization in Angola and in the DRC.
It's interesting that you talk about faith in the value of the currency. We know what is going on with the dollar and, of course, the euro, and we're seeing African countries embarking on increasing reserves and buying up dollars and euros. I mean, in the long term, and purely because you also look at these developed markets, do you think that it's the right strategy to embark on in buying into some of these developed world currencies, given the fact that perhaps the underlying factors are, for a weakening bias when it comes to the dollar and perhaps the euro as well?
Yes, but most of African trade in goods and services will be denominated in dollars mainly, and to a lesser extent in euros. So to some extent, keeping your reserves in dollars and euros matches your assets with your potential liabilities. Furthermore, at the moment, there are no other choices other than the dollar and the euro. It would be very silly to keep your reserves in Australian dollars or Brazilian real. You've got no relationship with those currencies. So yes, African countries do need to build their reserves. Dollars and euros are the right currencies to hold. In the Southern African setting, you can make a case for holding your reserves in rands, which is certainly the case, for instance, in Botswana, and then obviously Namibia, Swaziland and Lesotho, which have the rand pegs. It's the rand reserves that are dominant there because of the currency exchange rate. In the CFA zone, the exchange rate's pegged to the euro. Obviously, you're going to keep the majority of your reserves, if not all, actually denominated in euros. Again, matching your assets against your potential liability stream.
And John, it's quite interesting. We keep talking about hot money flowing into emerging markets because of quantitative easing too. Do you think any of that money is going to land up in various African currencies apart from South Africa?
Yes, we are certainly seeing a huge degree of interest in Africa, potential investments in Africa, both in the fixed income space, in the equity space, and in real foreign direct investment. I think you hit the nail on the head there, that we've got a slow growth environment in the the core markets, US and Europe and the other developed economies, money is looking for higher yields, higher returns. It's not only Asia and Brazil and the BRICS. The money is coming into Africa as well, and not just South Africa. Real money, portfolio capital, speculative cash is coming into Africa.